Mike, we got Charles on the line. What do you want to ask him?
One of my questions for you is how do you choose your markets? What are some of your most important factors?
Oh, that's a great question. So when we're looking at a market, number one, it's going to be landlord-friendly states. That takes a whole bunch of the United States. There's three main things we want to see. We want to see population growth for the last 20 years. We want to see job growth over the last 20 years consistently. And we also want to see a consistent decrease over 20 years of crime.
I'm Brian Briscoe, host of the Diary of an Apartment Investor podcast. And this podcast is different than everything else out there. I bring together a new and an experienced investor on each episode, and I let the aspiring investor ask the questions that they need answered. So if you're an aspiring investor yourself, you probably will have the exact same questions. Now, before we get to this episode, make sure you hit the subscribe button below and that little bell to make sure you get notified every time we post a new episode. And now, enjoy the show. Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe, director of the Tribe of Titans multifamily educational group and founder of Streamline Capital. And today we've got another podcast episode. It's an Ask the Expert episode, which I absolutely love these. We've got two great guys on the line with us. We've got Charles Carrillo and Michael Mccoy. So gentlemen, welcome to the show today.
Thanks for having us on, Brian.
Yeah.
Thank you for having me. Appreciate it.
Absolutely, guys. So most of the longtime listeners know the tradition, but we're going to hear from our experienced investor first. And so give Charles the floor for a second. So Charles, once again, welcome. And please tell us a little bit about yourself.
So I grew up in a real estate business, real estate background. My dad been investing in multifamily since 1984. I grew up and my dad he self-managed, and him and his partner, they never syndicated, but they had almost 100 units. And I would say it's C- D properties is what he was involved with. And he self-managed them with a small team. They're very management intensive. You can't bring him really to a third-party management to do it successfully. I didn't want any part of that. But when I graduated college and I was going through college, I kind of got the bug a little bit. So I got out and now we call it a house hack, but it was a 3-family. I lived in one floor of them. I rented out the other two. And that was at the end of 2006. So as we would look back, one of the worst times. But I bought another property at the end of 2008, another triplex, and better. But at the end of 2009, I bought a small mixed use commercial multifamily, and that was a steal. So, it just, you have to buy all the time. I think, you're always looking at deals and you're always reviewing stuff. And then I self-managed those properties from 2006 to 2012. Okay. I moved down to Florida. I had put in some professional third-party management in place of those, which was great because it got me more into acquisition mode and out of dealing with property management and all that kind of everything that goes with that. For the last few years, we've been focused here at Harborside Partners on strictly syndications, mainly in multifamily.
Nice. I mean, you bought in 2006. My first investment property was 2007. So I think we both timed it fairly well. And I mean, we were talking before the show, you've got some connections to Utah. My first one was actually just north of Salt Lake. My second one was a year later in 2008. So, I mean, we got started in the same line and I got a discount on the second one. The first one I had to hold for a while. I mean, well, it wasn't too terrible, but so self-managed for 6 years is what you said. Is that right?
That's correct.
Wow. That's a lot actually. So you were doing the leasing, you were doing when it was vacant, the advertising and everything else, all of it.
Yeah. And then toward the end of that, I started smartening up and getting a lot of other services outsourced. I had all maintenance done, landscaping, everything like that was done by other people. And then I had it got better at the end. And during the middle, you don't really know what you're doing. So it was kind of, and my dad kept a very arm's distance. So it was, I was making mistakes and, you learn what you're doing. But when I brought on third-party management, or at the time when I was prepping to bring on third-party management, because I had to have like a super and all stuff, that's when I started really systemizing it and, getting people that were coming every week to do things, and I didn't have to call people and stuff was done, and I just had to like write checks. Yeah. And I wish I'd done that earlier, but you learn a lot by, this was all C-class properties. Maybe one was a C+, but you learn a lot about dealing with tenants, dealing with contractors showing up and mostly not showing up, and everything else that goes. Everybody knows about it if you've self-managed for a year or two.
Yeah. And you know what? That's something I went back and forth between, property managers, and maybe my expectations were a little unrealistic. It's hard to find a good property manager when you have 2 single-family homes, or 3 single-family homes, or they're not going to, like I said, once again, maybe they're good property managers, but I think my expectations were a little high for what I was expecting. But I went back and forth between the manage it myself and this is too much. I need to find somebody else to manage it for me type things. But yeah, you learn a lot by doing, and I think it makes you a better investor long term, to be honest with you. So that was the first couple. Talk about the transitions to like larger multifamily. I mean, looking at your bio, you've been involved in a lot of deals. How'd you go from those couple of properties to larger properties?
Yeah. So during that time, I was doing some flips and stuff like that, and I didn't really like it. And it was just getting in. It was all just to get more capital to buy larger deals, right? And when the first deal I bought in 06, I bought it from landlords that were going the same route that I was following 10 years later, where they're getting out of small stuff, going into large stuff, larger stuff, let's say. And so I followed that because I sold that whole portfolio in 2022. But when making that changeover, it was finding a team to work with, finding a market. I was living with my now wife in St. Petersburg, Florida, and we found a group, and this was several years back, and we've done multiple deals with them. And it was in Tampa, and it was similar, I would say C+ type area, something like this. And we bought a few different properties in that area, and we did for our first syndication. It was really putting together the team. I put together part of the team. My partners added some people to the team, and it was a lot of work. It was a lot of work doing the first syndication, raising the money. We raised 1.8 million. I think it was a $3.6 million purchase of 59 units. It was literally a 32 unit building, traditional apartment building with an office. And then it was a handful of 3 and 4 units around it. So it was all close, but it was really taking down multiple properties. And you had like one portfolio, then you had 32. And that's how we sold it too. We thought we were going to sell it all as a 59. We actually sold it, got higher price by splitting it and selling it like that. But I mean, it was a lot of work. It was a lot of work to get the money together. It was a lot of work dealing with it. We went through COVID during the whole time, which was nothing that you can't get that kind of experience or information from anyone. It's just,
how do you plan for that? I mean, I bought my first 3 properties in the fourth quarter of 2009. And then, I mean, COVID, oh my goodness. How did you guys manage through COVID?
I just remember spending hours and hours on the phone with banks. And I was like, because you have no idea if anybody's going to pay. So I'm on the phone apparently with every other person that owned a property that had a bank, loan from that bank. And like, they're like, you can pay. I'm like, I can pay, but like, what happened? You know what I mean? Like, you're like, what happened? Like, everybody's telling me the world's coming to pieces. So like, what happens if I don't? And they told me the whole thing. And we never had any issues like that. We were very lucky, but it was, you just don't know. So you're planning on it. You're talking to your investors and like, hey, we're pausing distributions for like a quarter or two. We have no idea what's going to happen. And then we restarted them, but it was just something that you just don't know. We're just bankrolling money. We're like, that's one thing about a plus with what happened was that you had a lot of workforce housing. If you did, you were lucky that a lot of people didn't get laid off in your apartments. It's completely different from when you're talking about 07, 08, where if you had contractors that were living in your properties, you know what I mean? You'd be like, oh no, like they're not working. Here, you're like, if you had contractors work, you'd be happy because they're the only ones working. You're driving down the street, there's no one on the street, but just people doing, work. You know what I mean? Like contracting, building, stuff like this. So it was very interesting, but you really just have to tell people, hey, this is what we're doing. And just make sure you're shoring up cash, right?
Yeah, that's something. I mean, we went through the same process. We thought the world's ending. We called our banks too and just said, I mean, the feds came out with some, mortgage relief programs, and we started inquiring about those. Fortunately, we never had to tap into any of them. Fortunately, we never dropped below our break-even occupancy, so, and same thing, we paused distributions and, as things started ramping back up again, turned them back on. And it was probably more stressful than it should have been. But I mean, at least we were at the time, we were the newer multifamily owners at the time. It was a lot. So how do you plan? Yeah. But cool. So anyway, lots of stuff in Tampa. Where'd you go from there?
So we did a deal there, did another deal about a block and a half down, which we still own. We sold the first one, and we did a deal in 2021 because it was, you're making sure stuff pencils, and where we were with like interest rates so low, and a lot of stuff didn't pencil unless you got into really risky debt. So we were kind of holding off on that. We closed a deal at the beginning of 2022 that we had set from 2021. It was a holdover.
Yep.
And then we did another deal in the end of 2022, outside of in Dallas. So
Okay.
it's, we work with 3 different operators mainly. And so we come on and we're raising capital with them. We're performing due diligence, and we're providing some at-risk capital in the beginning as well.
Yep.
For loan fees and everything like that. So that's kind of how we work alongside operators that we work on, but we're very particular with working with operators that are very specialized in the markets that they're in.
Yes.
I want to see like many units, and that means that they have a very strong base. And then when you're coming in with your expertise, your investors, your money, and your investors' money, then you know that you're really, there's not going to be switching management companies. Like you were saying, Brian, I mean, like what a mess it is to switch management companies. And it's, hopefully you've never had to do it on a multifamily, but I've done it, and it's terrible.
It is.
My phone's never, I mean, it's easier for me to go there and start collecting rent. It was honestly, you know what I mean?
We've unfortunately done it a couple of times. I mean, we were kind of, we did not focus at first, which is something I've changed. We were kind of like shotgunned across 2 states where all our properties were. And so, I mean, at one point, I think we had 3 different management companies, who were all the local ones. And I mean, yeah, we cycled through them, and it's a nightmare. I mean, it really is. It's that the tenants have to figure out the new way to pay. There's always a disruption to operations. But yeah, going back, I think you really said something very important there, is you're looking for people who are focusing in one area. And, that's something that I realized, probably about, 6 or 8 months ago, that, a lot of people who are really crushing it in this industry weren't shotgunned around. They were focusing. They were focusing on, one metro, or maybe they built their business focusing on one metro, and then after 4 or 5 years split off to a second. But I think there's a lot of economies there, and there's a lot less to worry about if they've got a cluster of properties all in that same metro.
Yes, I definitely agreed.
Yeah. And then something else you said that I'll highlight for listeners, you're primarily bringing capital, but there are some broker dealer laws. I loved how you highlighted the other things you're doing. You're bringing risk capital. You're participating in due diligence. You're doing a lot of other things besides just raising capital. So point that out, because, you've got to do stuff like that to maintain compliance as a, air quotes, capital raiser. So
yeah. The other thing too with that is that you also, when you're talking to your investor, I mean, if you don't have firsthand knowledge of the property, you can tell your investors that, or you can tell them that you walked every unit, or that you were on site during this. It's much different. It's much different when someone from your team has actually gone there and done something. You know what I mean? So
yeah, and it's exactly that. If you're putting your money into a deal and trying to get other people to follow you, the more credibility you have, the better. So go visit the property. Take the time to go do it. And if you go visit the property, you find something you don't like, that's the cost of doing business. At least you're not in a bad deal. Are you out there for the full due diligence, walking every unit when you get into the deals?
It's about, I would say 75% of deals we're doing that. And someone from our team is out there. And if we've worked with the group before, it's a little different.
Okay.
We might give them a little bit more hands-on. But if it's in a market that we know, if it's in an area that we know, that's something that it would, we'll be on for certain things. We might be on the day that they're installing property management after we've closed. So that's one thing. It just really depends on how we've set up boots on the ground there.
You're leveraging your previous knowledge, your previous relationships with different sponsors. I like that approach. I mean, I think, me personally, I think the first time I'm doing business with somebody, I'm going to fly out first. And then, on subsequent deals, it's like, rinse and repeat. Like, okay, cool. Yep, that's a block away from your other one. Cool, let's do it. Well, awesome. So one thing I like to ask everybody, and that's about the why. So if you would talk about why you're doing this, what's your big burning why?
I would say initially it was freedom and autonomy for myself and for my family. Just being able to just have a little bit more freedom in your day and stuff like that. I mean, I've had a side business as well, or for years before. I have a partner that runs it full time, and it was an online business that I was using to fund my real estate prior to getting involved with syndications full time. Just being able to put that, not rely totally on that, was my first why. And then once we really started having repeat investors in our deals, that kind of changed. And it was really, I realized as being self-employed for so many decades, it was something that having the real estate income is something that is really important. Having something that's not correlated to your W-2 or your 1099 job. So I kind of preach this to entrepreneurs and to business owners,
Mm-hmm.
anybody that's busy professionals. And hey, like this is something where, yes, it's good having reserves in the bank, but it's also good having an income stream. So if something happens, and it's easy to diversify with syndications, much more difficult when you're putting in 100, 150, $200,000 into one property in one market, in one neighborhood, where you can put in 2 or 3 different deals and really spread your risk out. And now you have something that happened at one property is not going to affect you at another one. It's a really important thing. So that's kind of something that I love telling people. And that's kind of how my why has changed for helping people that are more on the 1099 or entrepreneurs, how they can really, how they can really add some additional income streams to their portfolio.
And it's amazing. I mean, that's what I'm doing too, is trying to figure out how many income streams, how many properties, how many different places can I earn money from, so that if one of them stops, for example, we're going to be okay. So that's very important. And I love that you're spreading that gospel around. So let's switch gears a little bit again and talk about some of the deals you've done. So, pick a recent one or your favorite one or whatever, and go into a little bit of details about the types of deals that you're investing in now.
So I would say we had a first deal, which was a 59-unit syndication, which we talked about. We did one after that, which was a 90-unit. Okay. And that was nearby, and that was a 68 unit and a 22. When we were buying in Tampa, you're able to, if you still get the scale of the number of units, but it's a little bit more difficult, and many syndicators don't want to do the portfolio model. Yeah. And it's something that if it's a little extra work, but we're able to get our pricing down per unit much lower when we're doing that, because most syndicators don't want to syndicate anything that's 50 or 60 units. You know what I'm saying? So it's something they definitely don't want anything that syndicates something that's 30 units. So if we're going in and we will buy that, now we can get a much better price by doing that and putting it into a group. So now you have, tell investors, there's multiple properties. Yes, they're close to each other, but they're also, they're going to give you, if a roof goes off one of the properties, it's not going to affect the other one. And you're having a little bit more scale for that. And that's going to save us some property management as well.
That's a model we've actually used before, where we found some smaller properties next to larger properties. Like we've done this twice, where we've had, properties that are about 80 units. One was an 80, one was an 82. And in both cases, we found like a 30 unit down the road and a 40 unit down the road from the other one. And we wouldn't have touched those otherwise. But the 80s are like just across that threshold where, man, you need to have on-site management, but shoot, it costs a lot compared to the units. But so yeah, we've done that too. And I think another lesson to learn from what you said, most syndicators don't want to touch those 30 to 50 units. So if you're somebody trying to get into the space, that tends to be a kind of a dead zone where, guys like Charles and me typically don't want to dive down and get those unless there's some synergy with some adjacent properties. So if you're looking to get into the space, that's a great spot to look at.
Yeah. It's also a huge benefit if you already, like you said, you already own in the area. So now when you're going and looking at that 30, so you pick up a 30 and a 40 on top of that, you can syndicate that in one deal. Now you have the people, everybody's winning. So 30 and 40 people that are new investors with you, they're winning because they're getting the scale of the 80. People in the 80 are now getting the scale of the 30 and 40. And now your landscaping costs per square foot of grass or whatever, however you measure it, is going down. And it's a fantastic thing. That's a huge win-win for everyone when you're buying more in one area. And now everybody across the board is cutting you deals.
Yeah, absolutely. Absolutely. So it's something that not a lot of people focus on. I mean, most people are trying to get the 100+ unit. They try to graduate into the 100+ units and stick in that area. But I'm glad you brought that up. I don't get very many people that have that philosophy. But yeah, if you can get clusters of smaller apartments in a short distance of each other, you can take advantage of it. You can have the economics of your 100+ units without having to, have to buy that one at a time. So anyway, cool. Well, thanks for sharing that. Well, last question for you, and that's what's coming up next.
So we're working on, we're still growing our multifamily, and kind of what we've been planning on is we're working with one group right now, another operator, and we're going to have some self-storage in the next 12 months. Opportunities come around. We have one group that has their own brand, and they've been around for about They've done about 15 complexes. So it's something that we are planning on adding that. We've had some investors ask about it. So we're in the stages of doing our due diligence and all that stuff that goes with it.
Awesome. Awesome. Great.
Yeah.
All right. We're going to shift gears again. Hey, Charles, first of all, thanks for telling your story. And now we're going to bring Mike on. So Michael McCoy, welcome to the podcast today.
Thank you for having me, Ryan. I appreciate it.
Absolutely. Now, do us a favor. Tell us a little bit about yourself.
Sure. Born and raised in Los Angeles, attended UCLA for engineering. And
Okay.
once I got out of school, had an engineering consulting gig. And in my downtime, I discovered Robert Kiyosaki and the Rich Dad Poor Dad series and caught the real estate bug and read a lot of books like his and similar and started to pursue real estate. Got my license back in 05, 07 area and started helping friends and family and other investors gather property that they were interested in on the buying side and sometimes the selling side. And then I realized, I wanted to get into the investing side, following the cash flow quadrant with the B and the I side.
Exactly.
And I sought out mentors, started going to networking events and found a mentor in a single family space, a big time flipper locally. He focused not only on flips and holding real estate in Los Angeles County, but also remotely throughout the country.
Okay.
And I was able to garner a few rentals in Northeast Ohio and Cleveland the last handful of years. And then during the pandemic, I started switching gears. I had some downtime working from home in my W-2, and I discovered a multifamily and the economies of scale is very similar to a single family investing. It's just that you're managing more doors at once and able to garner more rents at once. And it's just adding another zero, so to speak, and no difference. It's just able to exponentially grow. And that's what I've been pursuing the last year and a half to 2 years, putting in offers and walking properties and ready to go under contract on the active side.
Awesome. Awesome. So you've been around real estate for quite a while and you got a lot of traction going in the single family space. And I think like a lot of people, you look to scale, how can I take all this goodness and, do it a lot more and a lot faster and naturally land on multifamily. So cool. Yes. A lot of similarities there between, what you've done and what I've done. But so one question for you, and like I said, probably my favorite question that I always ask on the podcast, what is your why?
Right. So, growing up in Los Angeles with the entertainment industry in the background and having a lot of friends in different industries, I want to be able to live free with time freedom and also be able to pursue investments related to real estate and adjacent. So, to me, most people either make their money in real estate or park it there, and I like to do a little bit of both. I love the art of the deal. I went to school for engineering, so I'm particularly good at numbers, and I also just like working with people. So I feel like real estate is a business where you get the best of both worlds as far as I'm concerned. And my why is I want to wake up every day like it's Friday after work. So when you're in W-2, everyone lives for Friday. And to me, we should be living like that every day. So that's really my why, and also to supplement my mom's retirement. She's approaching retirement from nursing, so I want to be able to assist with that a little bit more than what she can do on her own. So those are my two biggest whys.
Nice. So you want 6 consecutive Saturdays, so that's what you're looking for.
7 if I get my way.
Yeah. I say 6 because just for me it's a religious thing to have at least one Sunday a week. But
agreed.
Yeah. So you're six straight Saturdays and then have a Sunday thrown in. So I like that idea. I like the idea. And also the family link there. So, well, once again, switching gears, and here we come to the question and answer part. So, Mike, we got Charles on the line. What do you want to ask him?
Sure. So Charles, I appreciate your time. It's great to hear your success stories and all the transition you've done from where you started to the arena you're in now. One of my questions for you is, how do you choose your markets? What are some of your most important factors in an emerging market right now?
Oh, that's a great question. So when we're looking at a market, number one, it's going to be landlord-friendly states. So that takes a whole bunch of the United States. There's three main things we want to see. We want to see population growth over the last 20 years. We want to see job growth over the last 20 years consistently. And we also want to see a consistent decrease over 20 years of crime. And the consistent decrease in crime shows that crime is decreasing, but it also shows that municipality is investing into education and health. And that's something different that you just can't find on a normal website when you're doing your due diligence. So those are the three main high level things, I guess, four main, I guess you would say, with the state that we're really looking at initially when we're going into it. And then you can really drill down more, especially when you're getting into a submarket.
Yeah,
Awesome.
I like that. I like the approach, long-term growth. I think a lot of people are trying to find the hot markets now, but if a city's been growing for 20 years straight, it's probably going to keep on growing.
Right.
Something I'll add to that for you, Mike, is those metrics are all important. But something I've always looked at is we're somewhere that you have a natural connection with, so look at the places you have a natural connection with. And if you can put the two together, there's a city that you're frequently going to, or that you're from, or that you've lived in at one point in time, where you have that natural connection, where you have a detailed knowledge of the city, and they exhibit all those growth points. I think that's probably the best way to link the two together.
Okay, awesome. And this economy, it's ever changing, especially since the war in Ukraine, I would say. Charles, what are some of the strategies you're utilizing to navigate the rising interest rates? As I put in offers, I'm considering financing a whole bunch based upon that number. So what are some of the things you and your group are doing to mitigate that?
Number one would be just with the market has how we are now, and just to answer your first portion of that question is going to be, we're really focusing on light value adds, maybe touching on some medium value adds, but we're avoiding all heavy value adds. And just where we are in the economy, when we're flipping units and we're updating units, we're doing a little less than we would have if the market was still in the uptrend. And that way we're testing the appetite with every unit that's been updated and re-rented. We know exactly what the market is telling us. And if that market's telling us, hey, clean and paint units and rent them, that's what's going to keep occupancy high and collections high. That's what we're doing. And we're still going to update units, but we might not be doing 5 per month. We might be doing, on one property, we're doing 2 per month. So that is that really just keeps the vacancy low, and so we can navigate what we got going on the interest rate portion of it. That's a great question. Just making sure if you're getting it from local banks, then go in there and make sure you're getting like 5-year ARMs. You know what I mean? You're getting fixed term for 5 or 10 years. That's going to give you a lot of breathing room, so that when you come up with that, when you're coming up to do a refinancing, it's not right behind you. The other thing too is that if you're doing any type of floating rate, which I wouldn't suggest anybody doing if it's on their first deal, just stick with, like, when you're doing your first real deals, like, stick with as much fixed as you can. And if that's on 3 units or 4 units, I mean, I didn't get involved with anything on financing, I mean, till probably my 4th or 5th multifamily deal, I was getting involved with floating rate stuff. So getting stuff with fixed, even though banks want to sell you a 5-year or 10-year, I've gotten 25-year fully amortizing ARMs on commercial property from banks. You just have to do a lot of calling. So that's one thing too, is start building your relationships with local bankers, because they're much different than people think. They have the ability of, they live right where you're buying property, and they are the ones that there's usually a small committee of like 3 people that are making the decision, and they're more likely to work with you on a down payment if you have some relationship with someone there.
Yeah, a lot of good advice, and I wholeheartedly agree with the local bank one. I've been, GP in 12 different properties. Half of them we've used local banks, and we've been able to get a lot better terms, fortunately, than a lot of the national bridge products in the last couple of years. So, when a lot of people are looking at those adjustable rates, going off the hook right now, sitting pretty with a 3.7% fixed rate on several properties from the same bank, So yeah, a lot of goodness on that one. Very, very much agree with that. And I mean, a lot of gems there.
Awesome. So Charles, if you were in my shoes, a new multifamily investor on the brink of closing his first deal, Where would you start? Would you start with C class, value add, stabilize, certain number of units? Curious, if you were to start all over now
Mhm.
in this market, what would you pursue first?
That's a great question. I would start, my first property I did was kind of a medium renovation type deal. And I would have had a much more stabilized, let's say, light value add, if any kind of value add initially on the property. So get in with something, the fixed rate debt, something that requires minimal work. And there's going to be work that's required. Don't worry. You'll have a lot of work
Right.
that's required. But the thing though, is that get in with something, you're lucky you get some rents that are underneath there,
Yeah.
and you can still turnkey, kind of come into it with everything's being paid. You know what I mean? And you don't have to do anything major. You don't have to upset anything. And you kind of understand how to work with tenants, how to work with all the different moving pieces. And I think that would be number one. So get in with something that's needs minimal work. And then on your second and third deal, that's when you start having contractors, relationships with handymen, a good property manager, because maybe you have to switch it. Once you get all that stuff lined up, that's when you're getting into bigger projects.
Yeah. Love the advice. Keep it simple on your first deal, because if you're getting into a new industry and assuming, you haven't done multifamily deals before, keep it simple. I would also say, and I hinted to this earlier, that there's a small space of unit count where, the syndicators, the established syndicators usually don't want to get down to, and maybe your individual investors can't quite reach. That's a really good place to start. Maybe in the 20 to 60 unit count, your high paid professionals can't quite hit those purchase prices, and your syndicators don't want to drop down to that area. So you'll find that the management is a little more difficult. Don't get me wrong, but you'll find that there's a little less competition in that space. And, once again, as far as the keep it simple principle, it's going to be a slightly lower purchase price. So your first capital raise is not going to be that intensive, and you'll be able to get into it. And to go one step further, if you're trying to make it a little easier, getting to that first deal, I wouldn't build a business around this, but maybe you want to start looking at like outskirts, secondary markets, smaller areas where there's a little bit less competition. So, but yeah, I wouldn't want to build a business around. I've had a lot of assets in tertiary markets, and they can be roller coasters in bad ways. But find a reasonable sized property, 20 to 60 units, get your feet firmly planted on the ground, and move up from there.
Awesome. Thank you. Order of operations, some people want to find a deal first. Some people want to capital raise first. Some people say try to do both at the same time. When you're starting out, I get different reasons of advice for which one is best. What would you say you would suggest to do? So find the deal first, or to get out there and have a capital stack ready to go first?
It's a great question. The capital, I think I speak to a lot of people that are in their first syndication, and I've done before, and they think it's a lot easier to raise capital than it really is. So it's something that you have to start that like right away. Start raising capital, start talking to people, it's going to be harder than you think. In the beginning, it's harder than you think. After a while, then you're getting referrals, then you're having people come back and invest. It's much easier, right? But in the beginning, to get that snowball really going, you really need to get out there, talk to people, coffee, calls, Zooms, the whole 9 yards. And then what I would do is, once you kind of have an idea, because, this is what your broker is going to ask you too. And if you go to that broker and you're very confident about the amount of money you can raise and what you can bring, they're going to kind of have that same mentality going across to the seller and telling them, when they go across the table and talk to them and say, this is solid, this is a very solid person, blah, blah, blah. If you're not really sure, that it's not going to be, if you're not confident enough with it. So I would make sure that you have a lot of your money set up, and a lot of it's going to fall through. And just to let you know, you're going to have to raise twice as much. So just keep that in mind. You have to raise $1 million, get $1 million, get 2 million, and don't take anybody that's giving you $500,000. That doesn't count.
Yep.
Get somebody, you don't want anybody giving you over 100,000. If they do, great. You put them down for 50 or 0, but it's like, Brian, you've been through this apparently.
Yeah. Yeah. I mean, I know a lot of people that talk with somebody who's interested in investing, and they throw out a number that's really, really large. Yeah. Nobody gets that big number on their first investment, and people, like a lot of your accredited high net worth investors, they're not going to drop that much money into one single asset, especially with a newer syndicator. So yeah, I've seen this half a dozen times where man, I just talked with somebody who says he's interested in investing. He's got $2 million, and they chalk it up as a soft commit for 2 million. It's just like, it doesn't work that way. But yeah, I mean, absolutely on a lot of things he said. So speaking of millions, an example I'd like to give is if you walked into a broker's office with a suitcase full of $5 million in it, set it on the table, open it up, and say, hey, Mr. or Miss Broker, I've got $5 million. I want to purchase something, in the 4 to 4.5 million range. And, what's left over is going to be my operating budget, my capital, cap expense pile, and everything else. I mean, how quickly is that broker going to find you something that meets your criteria? I mean, the answer is very fast, So when you look at it, money talks in this business. So if you're ever wondering which to go at first, lean towards the capital first, because you're going to have a lot more traction with the brokers. So anyway, that said, we are about out of time. Great questions, Mike, Charles, a lot of good discussion points. One last question for each of you. Charles, you get to go first. How can listeners learn more about you?
So if you're interested in learning more about passive investing with us, or if you have questions about active investing, our website is harborsidepartners.com, harborsidepartners.com. We have a free passive investing guide on there that you can sign up for. And if you're interested in investing, you can sign up for our investor club right there.
Awesome. And same question for you, Mike. How can investors learn more about you?
Yes, I have a website on globalallianceproperties.com. I also can be reached by email at globalallianceproperties@gmail.com and Michael McCoy on Facebook.
Awesome. And we'll make sure those are in the show notes. So anybody who's looking to connect with those guys, that's where you find them. So thanks very much. Appreciate your guys' time today. And, best of luck to you in finding your next deals.
Thank you so much.
Thank you.
Hey, if you like that episode, make sure to subscribe. But more importantly, if you haven't joined our multifamily educational community yet, which we call a Tribe of Titans, you are missing out. Get 30 days free by clicking the link in the description to this episode, or go to thetribeoftitans.info, and we'll see you there.